Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Happy New Year, everyone. Welcome back to Macro Insight. So today is the 5th of January, 2021, and let's take a look at markets. So lots to talk about. Lots been going on since we last spoke. So, markets had a pretty decent run sort of over the holiday period. So let's just discuss that quickly. Bring up the S&P chart. So you can see we had kind of been going fairly sideways, and then we had that last push up. Daily. And then we had that push up, and we managed to make highs of 37.80, okay, which was yesterday. Markets in general, the kind of vaccine optimism had continued to come through, despite the case explosions that we've been seeing everywhere, particularly in the UK. Everyone getting obviously very concerned about this second strain and the numbers of cases exploding in the UK. Also, pharma companies, had been slashing the numbers in terms of how many vaccines were going to get delivered versus what their original estimates were. Things like that, not ideal, and that has led the UK to kind of go into another nationwide lockdown, similar to what we had last spring. And they're talking about reviewing that middle of February. So schools shut. Pretty much everything shut, so not great for us who are stuck here in the UK. In terms of markets and why they rallied sort of into the end of the year, we did get the stimulus package passed in the US, which was around $1 trillion. We also had the Fed kind of reassure markets, and that general kind of trend continuing. And there's definitely a belief that the Fed is, after they changed their language towards average inflation targeting last year, the fact that they made that change means that they are pretty much saying they're willing to let the economy run hot if they see inflation. They're not going to come and tighten anytime soon, right? So markets fairly optimistic about that outlook for this year. Yeah. So the market investors are looking past the mess on the ground that we're clearly seeing with the COVID situation, and they seem to be very good at forward pricing the optimism that we're going to get through this, and look at Q1, Q2 having reasonably decent data economically once we do reopen, right? So what I've noticed over the years is markets are quite good at looking forward when it's an optimistic scenario, and the harsh, like the bad scenarios, they kind of ignore them until they can't ignore them anymore, and then they price that in at the last moment, basically. So if you look at what happened in March last year, we had COVID kind of appearing in January in China, and it was just shrugged off, and it was only until they just couldn't ignore it anymore that markets suddenly repriced that to the downside, right? So that seems to be the liquidity-driven markets that we're in. We tend to see that behavior where good news gets priced, optimistic outlooks get priced into the market on the bullish side, and kind of bear cases don't get priced until the absolute last moment, basically. So hopefully that doesn't happen again, but you could see a situation where if COVID really does get out of control again, and probably not this current wave we're going through, because you'd expect that to be kind of in the price of markets, although we have had a reasonable correction over the last day or so. We'll talk a bit more about why maybe that's happening. But in general, I think things would have to get a whole lot worse for us to price in anything like the kind of moves we saw last spring, right? So it's difficult to see, a meaningful drop in markets in Q1. As like I say, all the economic weakness that we're experiencing right now is already priced in and expected, yeah. But then you've got the base effects of inflation and growth as you compare to last year, where the change year on year is likely to be beating to the upside quite significantly, right? Provided we do manage to get the vaccines rolled out and you get some kind of normality appearing by the spring of this year, then those comps should be quite easy to beat, and markets will probably rally on that, basically. Yeah. What else? So the reflation trade is the reflation trade, and the weak dollar has been the dominant narrative driving this kind of global recovery that we're seeing, or we're hoping to see. It's not even that we're necessarily seeing it, right? It's more what we're hoping to see that's being priced into markets, and people are positioning for that. So long EM equities has been working. I probably expect that to kind of continue. People like Brazil and India at the moment are saying these are two potential markets that could do quite well if this kind of recovery story continues to play out over the next 2 quarters. So that's one thing. Also, in equities, people still think tech is an okay place to be. So you obviously had that rotation away from tech and into value stocks after the vaccines came out. But if you look at where techs are, I mean, the Nasdaq's been doing pretty well. And kind of the setup that we have, most likely tech will continue to do quite well in, right? And, this kind of working from home and stuff is still ongoing, right? So, we certainly with the latest lockdown. So tech is, not far off its highs. It made new all-time, Nasdaq made new all-time highs recently, right? So there definitely doesn't feel like there's been much of a rotation out of tech. It's more been people have got into some of those value names, or had briefly got into some of those value names. Maybe some of that is going to get taken back out again. We shall see. Yeah, financials obviously were part of that value sort of subset, and people are a bit more optimistic on financials now. Obviously, banks are now allowed to buy back their own shares again. That could be quite bullish. If you think about the way the Fed has responded to the crisis and the access to liquidity that these big corporates have got, you could definitely see a situation where banks start buying back their stock, yeah, with excess money that they have, and that could drive financial share prices up quite a bit, which again would take the broader market higher as well, right? You obviously had this drop in markets. I mean, we had been, that sort of bullish sentiment and bullish narrative had been getting quite extreme, right, over the last few weeks. So some sort of pullback kind of to be expected given where we were, but I don't think it's anything to get panicked about just yet. So could it have a bit more to go? Yeah, well, we've got the jobs numbers out at the end of the week in the US. Probably not going to beat to the upside, if we're honest, these jobs numbers. Should it be a major surprise? Probably not. Could it lead to a little bit of market weakness? Maybe, now that the market is kind of having a little bit of a correction. But it most likely, I think dips in this market over the next 1 to 2 weeks are probably buying opportunities for the next few months, right? So that kind of theme of vaccines getting rolled out eventually and normality returning and investors positioning for that, I think that's going to continue. So I think, buying dips in risk assets is probably going to be the way to be. I mean, if you look at where the VIX is, the VIX had a nice pop yesterday as well with the correction. And it remains pretty high, right, versus realized vol, right? The kind of realized that we've been seeing. VIX is at like 28.5. So very, very inflated VIX versus what we've been realizing. So even though markets are at highs, that doesn't mean markets are necessarily that complacent given the level of the vol. So that means that as we've been trading higher, people have been hedging through optionality, their exposures, because it doesn't feel, the world doesn't feel like that great a place right now, especially the fact that a lot of us are still in lockdown, right? So it makes sense that people have remained hedged, and that probably mean any dips in the market are going to be relatively short-lived as people unwind that protection and scoop up more exposure to the market, basically, as they try and look forward the next sort of couple of quarters. Yeah. What else have we got going on? We've got obviously the Georgia runoff elections happening today. So we'll see if the Dems can get can get the Senate, basically. If they get full control of the Senate, if they win that, then we're talking about a blue wave. What are the implications for a blue wave? Well, you've got, you know, various sectors that could do well. Obviously, clean energy space has already had a great run. That, if I bring up the ETF on that, you can see. So that's been the chart on the since the election happened there. So I mean, it's up pretty impressive, right? It's up about nearly 40%, yeah, since there. So solar, all that stuff is included in this ETF. If we get a blue wave, then this thing probably continues. I mean, it looks pretty stretched as we look at the chart now. So some sort of correction in this probably would be likely at some point, but the blue wave news, maybe this is pricing in quite a high probability of a blue wave. So if we don't get a blue wave, this kind of global clean energy ETF probably has some sort of correction and may offer you a chance to get back into this trend, because this is a super strong trend right now, which I suspect is likely to continue. But, you know, looking at that chart, you know, don't really want to be buying into that at these levels, most likely. Yeah. So that's the runoffs. What else? Like I said, you know, you got the jobs report on Friday. So if you get any weakness, might be a chance to start picking up things that you want to hold for the next few months. I mean, the big thing, commodities, obviously, we'll talk a bit more about commodities in a minute, but commodities is another theme for the next couple of quarters. Yeah, that it's already started quite aggressively over the last quarter. Commodities really started to take off, but I think that trend is probably going to continue. So buying dips in things like copper, some of the soft ags, things like that makes a lot of sense. That's if they give you any dips, right? But that remains to be seen. We've obviously got the dollar kind of driving everything. That dollar weakness has just been relentless. Take a look at that chart. Just loading up. So DXY kind of made new lows over the last couple of days, but has had a bit of a reaction to that. Despite making new lows, its momentum to the downside has been running out. Yeah, so I've been talking about this, and generally for me that signals some sort of bounce on the way, but these bounces are just so short-lived, right? So last time we had this, we were on the 17th of December, we were making new lows, we weren't really doing it with any momentum, and then we bounced by little over 1%, and intraday gave all that back, basically, right? So same sort of story here. Yesterday we made lows, we had a little bounce, we're already kind of feeling quite weak again. So is that going to be another flash in the pan, or is the dollar really going to manage to stage a bounce? If the dollar manages to stage a bounce, you know, I'd probably top end of that bounce is going to target 92, which is a couple of 2 to 2.5% rally from here for the dollar. But the way things are going, you know, that would be pretty impressive, right? It's really, really struggling to bounce the dollar right now. So, in the face of a blue wave, I imagine the dollar's going to have another leg lower, right? Longer term, dollar chart, if we bring up weekly chart on the dollar, massive level around kind of 88, 88 and a half. If it takes that out, then there's a bit of an air pocket down towards this 82, 84 area. Yeah. So dollar's at quite a important inflection point here. Generally with these FXs, I wouldn't expect it to break on the first test. So I would expect some reaction. I think if you look at that chart, you know, a bounce towards 92 is like back towards that weekly average would be quite healthy before it then has its collapse through that support level, right? So I definitely favor that. Generally, how do I like to play that? I quite like playing dollar versus emerging markets. So dollar ZAR, if you see here, dollar ZAR got to a pretty nice level, lower Bollinger Bands, sort of support level, horizontal and upward sloping trend line. So around this kind of 14.5 level. It's reacted quite nicely off there already, despite DXY kind of being where it is. So that's quite encouraging price action for dollars are. So, you know, not the worst way to maybe play the dollar bounce trade. Yeah, so that's one way I'm trading. That's one way I'm positioning at the moment. Not a massive position, bit tactical, you know, would look to kind of flip it out. Say we got back towards, you know, if I go back to the daily chart, you know, it's already done a reasonable amount from 14.5 to 15. You know, if it can get itself another sort of 2 to 3% higher, that may well be enough, right? So, and play a nice little tactical dollar bounce off that. Yeah. Pound obviously had its own story going on over the holidays. So, you know, we had market was gradually pricing in that we would get a Brexit deal, and lo and behold, Christmas Eve, we got a deal. They were, you know, their disputes, a lot of their disputes were over fishing rights. Boris had to massively compromise on fishing and keep dropping down, you know, how much the French would have to give up, basically. But he was always, I guess, you know, if you look back at it, it made sense that he was always gonna give in on fishing, because fishing makes up such a small percentage of the UK economy, right? So then the question, and that's why I was saying that even if we get the deal, you'll get this, because it's kind of priced, you'll get this knee-jerk up towards 136 to 138 area, but then the market kind of needs to be faded because the UK economy has got bigger problems right now. Obviously, the tougher lockdowns coming in is one potential catalyst why you wouldn't necessarily be that optimistic on the UK, but then every country's going through that, and even the US may well have some lockdowns coming once Biden gets inaugurated, and their next wave has had time to kind of penetrate through the population. So we don't know what's going to happen in the US with regards to COVID and lockdowns. But obviously you've had a lot of dollar weakness. That's kind of helped the pound, right, rally. But, you know, the biggest problem with Brexit is financial services, right? We don't know what the long-lasting impact is of all of this kind of, all these companies having to relocate out of the UK to be able to do business with European clients on financial services, right? So I think that's going to be the big drag, and that's what we're going to see manifest over the next, you know, couple of years, right? It's a bit hard to really know what those numbers are going to look like, but doesn't make me bullish to the UK, and it doesn't really make me bullish to the pound, to be honest, right? So even though people are very bearish dollar at the moment, I think there's a case to be bearish all fiat currencies, and that includes the euro and the pound, right? So right now, the euro and the pound have had decent rallies in the face of dollar being relatively weak compared to them. But at the end of the day, everyone's in the same boat. Every economy is going to struggle and have these challenges, similar challenges to deal with. And at some point, it wouldn't surprise me to see, especially cable, come lower, but even euro, right? I mean, euro, ECB has said they don't like it up here. At 125, they're absolutely going to hate it. So I imagine there will be some work to be done by the ECB to get the euro back down below 120 at some point. Yeah. So I just think all fiat currency is the issue, and we should see that as the ongoing theme of fiat currency debasement, yeah, for this year. So this is the chart I put up on Twitter yesterday. So gold has had, you know, I've generally been quite bearish lately on gold. I mean, I got bearish as soon as that vaccine news came out. But then, you know, that first support level, well, no, the second support level here at 1760 got you know, it got respected, and we bounced sharply off that. But I thought we were going to get a retest of that. So for now, we haven't managed to. We've rallied up to this level here at 1945-ish. And this whole sort of zone from 1945 to 1975 or 80, that's a pretty big resistance zone. So I'm basically calling that the, you know, the last hurdle, basically, right? So if that breaks, you know, if we get, for example, say we get a blue wave confirmation and that breaks to the upside, then most likely gold's going to take out the highs imminently, right, over the next month or two. If it fails here, then I think the retest of the downside scenario is still on, basically, right? And really the main thing to keep an eye on there will be real yields, okay? So if real yields, you know, go up, then I'll probably be right, and this thing will get rejected and we'll roll over again, basically. Yeah. But for now, real yields, you know, aren't really doing too much. And so because we, you know, we haven't really seen the bond market absolutely collapse, right? So only if we get a real inflation scare and we see the bond market really sell off hard, then we might get that pop in real yields, basically, and then gold will sell off. But for now, market kind of like the stimulus news, and gold's being a bit supported by that, basically, and the weak dollar, right? Weak dollar and stimulus news is kind of being supported for gold, and that's what's managed to get us back up here. Yeah, it's a big level above, like I said, above 1980. I think it can go quite a bit higher. Yeah, ultimate targets for gold maybe by the end of this year. You know, I'd say potentially could go as high as 2,400. Yeah, I'll be surprised to see it much above 2,400. But like I say, for now, big level of resistance to watch. Yeah. Silver, also interesting chart. Where are we? So silver, kind of similar chart, but you know, you had this congestion area around 27. That's where we got back up to. You know, if it takes this out, it's kind of toying with it. If it takes this level out, next stop is kind of those highs at around 30. And if it takes out 30, then, you know, who knows, right? Then it could really start motoring again, right? We've seen what silver can do when it starts going. It can do $10 very, very quickly. Yeah. And, you know, with the whole clean energy thing, if that goes through, if there's blue wave catalyst, who knows, right? Silver might get quite excited if it's potentially going to be used in solar panels and stuff like that, right? Solar technology. So some potential catalyst there for silver as well. Yeah. But yeah, longer term, like both these metals, but would like to see a correction to buy them again, basically, right? And think over the next quarter at least, if the world is getting better and that kind of reflation narrative is working and it's because of potential economic recovery, then I think maybe gold and silver aren't going to be quite as bullish in that Q1, and they might give you a chance to buy them again, basically, right? But remains to be seen. Yeah, quite an interesting dynamic, that one, right? What else? Commodities in general have been, you know, super strong lately. I mean, here's wheat chart I had flagged. Wheat kind of had its correction into early December, managed to pick some up, and it's up again. Soybeans never really had as deep a correction. That's at the highs. Corn, same story, been extremely bullish corn. It's got a bit parabolic corn, to be honest. You know, I don't know the specifics of each of these grains and like what's driving these stories, you know, whether it's weather or whether it's harvest or whatever it is. But in general, the whole grain sector has been very, very bullish, similar to the base metal sector. So you've got copper chart's been very solid, going through a bit of a period of sort of consolidation now where it's been sort of treading sideways for best part of the month. But certainly still one where I think buying dips makes sense, right? Trends intact. You know, if you're lucky enough to get a dip to kind of the 330, 335 area, then I think that'd be a nice opportunity to get long it again. Yeah. Okay. So that's commods. And then, you know, probably the most exciting asset class by a country mile has been Bitcoin and crypto. So let's bring up those charts. Actually, bring up mine. So yeah, Bitcoin, you know, we had been talking like last time, 2 weeks ago when we spoke, you know, Bitcoin was taking out 20,000 and it went to 24,000, kind of stabilized there for Christmas. But the move it had sort of over the New Year period was spectacular, right? So it's, you know, it got as high as nearly 35,000. I'll bring up the chart. Let me expand that. Yeah. Put it on daily. Yeah, so you've had a spectacular move. There was that first break of 20 up to 24, stabilized there, but then you had a move from 24 to like 35,000 in short order. And to the point where it was really starting to go crazy. It was really looking very, very overbought. So I posted on Twitter again, a couple of days ago that a correction is due here. And partly just because, if you look at the RSI was at 93, the weekly RSI, right? That is an absurd level for the weekly RSI. I mean, that's higher than the weekly RSI didn't even get to 93 in 2017 with the kind of moves we were getting in 2017 when it did like 10x. Yeah. So, for the weekly RSI to be at 93 here was, to me, signaling that we have got to be getting some sort of pullback, right? So that, I mean, it wasn't that complicated analysis. It just felt like there was just too much press attention. Obviously, the institutions have been buying it. There's been a bit of a squeeze on, not enough supply, and a load of new fresh demand has come in. So there were fundamental drivers, but it just got overcooked, right? So that's what it felt like to me. Obviously on the daily chart, you can see we had a big pullback, but it was brief, down to sort of 28,000 from highs of 35. So I said, watch out for a 5,000 point pullback. We managed a 7,000 point pullback, but it was very short lived. Now, generally with these corrections, I suspect they're not just going to be flash in the pan like that and over. So I'd expect, one leg down, some bounce, and then a final leg down to kind of finish that correction off. So I'm personally looking for, a move towards 2,600, something like that. Okay. So that, I said this correction's in progress. So this is the kind of shape of the correction that I anticipate, where we had our A move down to 28, we had a B, which took us back towards 32. And now hopefully the C, if it transpires, can get us just below 27, maybe as low as kind of 24. If that can happen, and these blue horizontal lines are like my main sort of Fibonacci retracement levels for the move up, basically, right? So this is where I expect support to be found. We already found it at that first one at 27.5. So, we may find it there again, or the next level below that is 26-ish, and the next level below that's 24-ish. So anywhere around those sort of supports will be places where I will be looked to re-engaging with some tactical longs. Right? I mean, obviously I've got my long-term structural longs that I've been accumulating, but I also trade this from a short-term tactical perspective. And, those are the levels that will be on my radar, to be getting back involved here. All right. So obviously that's Bitcoin, and that's been a big driver and a big story. Ethereum's the other one that has gone crazy lately. The best way to track Ethereum is through this spread, Ethereum versus Bitcoin ratio, where you just divide one price by the other. So that was, pretty weak over the holiday period, and it was making lows. And then literally on the 3rd of Jan, it decides to, come back to life again, right? And it seems to kind of go through these phases where Bitcoin ratchets up because there's a big buyer of it who just takes it up a few $1,000, and Ethereum's left behind. And then after a couple of days, people look at it and say, well, that spread's the wrong price, and then it gets repriced and Ethereum massively catches up, right? So that's kind of what's been happening. That's what happened here in 19th of November. So late November that happened, and it's happened again now. So in terms of the actual level of that ratio, it's kind of where it's been in September last year. So where it lives is kind of in the middle of that range of where it lives, in the low sort of 0.023 and the highs of 0.04. Yeah, that's kind of where it has lived for quite some time, in that range. Now, if this thing wants to really break out, if you go a lot further back on this ratio, then you could argue that the really big massive level is this horizontal line around 0.04. Okay, if it takes that out from a longer term perspective, then you've got like a lot of room to like go to 0.053, and then even up here to 0.06, right? And then we're talking about serious outperformance of Ethereum relative to Bitcoin. Yeah. But until we see that break, you know, they're going to kind of move in line with each other, but they'll have periods where one of them's outperforming by 10 or 20% compared to the other one, and they'll just be chopping to and fro. But if this year is another Bitcoin adoption year where more and more institutions go in the space and more people get involved with crypto, and the DeFi space continues to grow and innovate, then you definitely could have a situation where Bitcoin, I'm just putting numbers out of the sky here, right? It's not like a forecast, but let's say Bitcoin's got the potential this year to be anywhere between 50 and 100,000, okay? If you manage to get to 100,000 by end of this year, you've done pretty well, right? I think, yeah, that's a pretty impressive performance. That's another tripling this year, basically. If that happens, it wouldn't be crazy to think Ethereum could do, you know, 5x maybe. Like it's potentially Ethereum could go to like 5,000, right? If people start to look at it and say, well, you know, this is where there's more value in the crypto sector. This is where the growth and the innovation is taking place. And then look at the market cap differentials between them, then Bitcoin's dominance could get, you know, could get threatened basically, right? So at the moment, if you look at Bitcoin, this BTC.D shows you the dominance of Bitcoin. It shows you like the market cap of Bitcoin relative to the whole crypto. And you've seen, you know, in 2017, in that massive rally, Bitcoin's dominance went from 95% to 35% as the whole altcoin mania kicked in. And then the altcoins all got wiped out. And then you've kind of been now ranging for the last couple of years at around 60 to 75%. That's been the range. So in this latest move up in Bitcoin, Bitcoin dominance has exploded as well. So it's saying that the whole rally has been mainly Bitcoin, not everything else, right? Everything else got left behind. So now that latest downtick in that dominance is because Ethereum's basically said, don't forget about me, you know? So could we get a situation where Bitcoin carries on, goes through 50,000, but this dominance continues to trade back down, and over that sort of 5-year history, you know, maybe we're probably never going to get back down there, but could we see this dominance go back to maybe a number something like 60%? Very possible. And that's only going to happen with a massive uptick in Ethereum, where Ethereum's market cap goes a bit crazy, basically, right? So that's the kind of scenario that I'm envisaging may be possible this year in a world where Bitcoin's 50 to 100,000 and Ethereum rallies by more, and it takes the dominance down to around that sort of 60 level. Yeah. So that's kind of how I would play it. That's how I kind of, you know, think about the context of what can happen this year in crypto, basically. Yeah. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.